If you're retired, see if this description might be you. You've worked really hard in your life, 30, 40, maybe even 50 years. You've built a really nice portfolio. Stocks like Microsoft, Apple, maybe Tesla, they've done really well for you. But now you're retired and you need some cash. Maybe it's a new roof for your house. Maybe you want to help a grandchild with college. Maybe it's just living expenses. And you're staring at your portfolio thinking, which one do I sell? Welcome to the Retirement Learning Lab. I'm Van Richards, and today we're talking about one of the most common questions I get from retirees. How do you decide which stock to sell when you need money? By the end of today's discussion, you're going to have a clear, repeatable framework that you could use whenever you face this decision. But before we get started, I need to give you the usual disclaimer. You see, everything that we discussed today is purely educational. This is not investment, legal, or financial advice that's tailored to your specific situation. I'm not telling you to buy, sell, or hold any specific security. Every person's situation is different, and you should always consult with a qualified financial advisor who knows your complete financial picture before you make any investment decisions. Stay tuned until the end of today's broadcast for more information on the limitations of this information. Let me paint a picture for you. This is a real scenario that I see all the time. You're 68 years old. You've been retired for 3 years and your portfolio's done well. You've got some Microsoft stock that you bought 15 years ago. You've also got some Tesla that you bought 5 or 6 years ago. And both positions are worth about $50,000 today. But your roof needs replacing. The estimate, $25,000. You need to sell one of these positions. But the question, which one? Your neighbor down the street, he says, sell Tesla. It's too risky. Your golf buddy says, keep Tesla. It's the future. Your son-in-law has an opinion. Everyone has an opinion. But here's what I want you to understand. This decision shouldn't be based on opinions or guesswork. It should be based on a framework. Give me a yes in the comments if you've ever faced this exact situation. Now today, I'm going to walk you through what I call the SEC framework for evaluating stocks to sell in retirement. Now, when I say SEC, I'm not talking about the Securities and Exchange Commission. I'm talking about S for stability, E for earnings, and C for competitiveness. This is the same framework that I use to evaluate stocks in general, but today we're applying it specifically to the question, which stock should a retiree sell when they need cash? Plus, I'm going to add additional considerations that matter specifically for retirees. Tax implications, income generation, tolerance for volatility, and time horizon. By the end of this, you'll have a clear decision-making process. Let's start with stability. When we talk about stability in retirement, we're really asking, how stable is this company's business model? Let's use Microsoft and Tesla as our case study examples. Now, I own these, but I'm not recommending that you go own them. Remember, I'm not recommending either of these stocks. I'm just using them to illustrate a framework. Now, Microsoft has multiple revenue streams. They've got Azure cloud computing, which is growing like crazy. They've got Office 365. Business and consumers pay them every single month. They've got Windows, LinkedIn, Xbox gaming. If one division has a tough quarter, they've got 5 to carry the load. That's stability. Tesla, on the other hand, is primarily an automotive company. I understand. Yes, they have energy and solar, plus Elon Musk says that the future is in robotics, but the vast majority of their revenue today comes from selling cars. You see, if car sales are slow, whether it's from competition or an economic downturn or supply chain issues, Tesla feels it immediately. The retirement question is this: when you're retired and you need money for a living, which business model keeps you up at night less? The one with 5 revenue streams or the one with 1? For most retirees, the answer is clear. You typically want to keep the stable holding and sell a volatile one. But let's keep going, because stability is only one piece. The second factor is earnings. We're asking, how predictable and consistent are the company's profits? Microsoft earnings are remarkably consistent. Quarter after quarter, year after year, they're delivering predictable results. Wall Street could almost set their watch by Microsoft's earnings. The consistency comes from subscription-based revenue. Businesses aren't going to stop paying for Office 365 or Azure. Their operating margins are outstanding also at 40 to 55%. Excuse me, that's 40 to 45%, get that right. That means that for every dollar of revenue, they're keeping 40 to 45 cents as operating profit. That's exceptional. Tesla's earnings are much more unpredictable. One quarter, they beat expectations. The next quarter, they miss. Why? Because their margins are heavily influenced by things like raw material cost, like lithium and steel and aluminum, efficiency at different factories, pricing pressures from competitors, and regulatory credit sales. They fluctuate wildly. Their automotive gross margin has been declining as competition increases. If you're living off of your portfolio, which earnings profile gives you more confidence? The steady, predictable profit machine, or the one that might surprise you in either direction? Again, most retirees are going to prefer to keep the predictable earner. But the third factor is competitiveness. We're asking this: how strong is this company's competitive advantage? And is it getting stronger or is it getting weaker? Warren Buffett calls this the moat. How wide is the moat that's protecting this company's profits, their castle? Microsoft has an incredibly wide moat built on current proven revenue streams. Once businesses build their infrastructure on Azure, switching to Amazon or Google Cloud is really expensive and complicated. Once you've trained your entire workforce on Microsoft Office, switching to Google Workspace is painful. This is called switching cost, and it's a powerful competitive advantage. Their moat is based on subscription revenues, which is significant. Businesses and consumers pay them month after month, year after year. That's predictable recurring cash flow. Plus, they're integrating AI with Copilot across their products, and that strengthens their existing moat. Now, here's where it gets really interesting with Tesla. And this is important to understand. Yes, Tesla faces increasing competition in the automotive space from companies like Ford and GM and Rivian and BYD and a lot of others. The EV market is getting really crowded, but, and this is a big but, Tesla isn't positioning itself as just a car company anymore. They're building their moat in 3 areas that could be transformative. First, full self-driving and autonomous cars. They have millions of cars on the road collecting real-world data. That data advantage compounds. If they achieve true autonomy, they could license that technology, or they could create a robo-taxi network that could completely change their revenue model. Second, AI and robotics. The Optimus Humanoid project is applying the same AI and automation expertise that they've developed for cars to general purpose robotics. If successful, this could be bigger than their car business. And third, energy storage. Their battery technology and energy storage systems like Megapack and Powerwall position them for the renewable energy transition. Now, Elon Musk has publicly stated that Tesla should be valued as an AI and robotics company, not an automotive company. So which mode is better? Microsoft has proven and it has a wide moat that generates massive cash. Tesla has potential that's a transformative moat that could be worth multiples more tomorrow. This is where your personal situation really matters enormously. If you're 68 years old and you need reliability and income now, Microsoft's proven subscription mode is probably more valuable to you. But if you're 65 in great health and you have other stable income sources and you don't need that money for maybe 10 or 15 years, Tesla's AI and robotics potential might be worth the volatility and the uncertainty. There's no universal right answer here. It all depends up to your age, your health, and other income sources, your risk tolerance, and your belief in different visions. Now, for most retirees, a proven moat beats a potential moat. But for some retirees with longer time horizons and risk tolerance, the transformative potential might be worth keeping. Now, I know that we're covering an awful lot of ground, and Social Security planning can get really complex, especially when you're trying to coordinate it with your overall retirement strategy. That's why that I created something that might help you. It's called the Complete Social Security Planning Guide, and it's absolutely free. Now, this guide includes a detailed worksheet that's going to help you to calculate your specific benefits at different claiming ages. It has tax planning strategies to help you to keep more of your Social Security income. Spousal coordination worksheets. If you're married, it's a step-by-step decision framework, and it has a list of common mistakes to avoid that could cost you thousands. If you want to download it, just go to ss.vanrichards.com. That's ss.vanrichards.com. It's completely free. I created it because these decisions are too important to guess about. All right, let's get back to our discussion. Now, before we move to the additional retirement factors, I want to pause and I want to address the elephant that's in the room. What we're really talking about here is a classic investment dilemma. That is the proven investment versus the transformative growth. The Microsoft case is this: massive reoccurring subscription revenue today, predictable cash flows that you can model out for years, dividends that are hitting your account quarterly, steady growth, but probably not explosive growth. You know what you're getting. The Tesla case, it's transformative potential in AI and robotics and autonomous driving. If they achieve full self-driving, the business model transforms entirely. If the Optimus robot works, it could be bigger than the car business. Revenue could be 5 to 10 times more in a decade if the vision plays out. But it's speculative. These are the bets of the future. Here's the honest truth. Both are legitimate strategies. Neither one is really wrong. The retiree who keeps Microsoft is saying, I've worked hard for this money. I want stability and income, and I want to be able to sleep at night. I'll take the steady 10 to 12% annual growth over the potentially explosive but uncertain growth. The retiree who keeps Tesla is saying this: I have other stable income sources. I can afford volatility in this position. I believe in AI and robotics vision, and I'm willing to accept the uncertainty for the potential of life-changing returns. Both can be right depending upon the individual situation. Let me give you a real framework for making this decision. Keeping Microsoft. This money represents a significant portion of your liquid net worth. You don't have other stable income sources like a pension or rental income. You're over 70 and you need money to be reliable. You value sleep at night over maximum growth potential. You want dividend income. You keep Tesla if this is growth money. You don't need it for 10 years plus. You have a stable income from other sources like Social Security, a pension, or annuities. You're in your early to mid 60s with a longer time horizon. You have conviction in the AI and robotics thesis, not just hope, but conviction based on your own research. You can emotionally handle a 40 to 50% drawdown without panicking. And that's happened. The key is being honest with yourself about which camp that you're in. Now, the SEC framework gives us a solid foundation, but for retirees, there are additional critical factors to consider. Here's factor number 4, tax implications. This is huge. Let's say that you bought Microsoft 15 years ago at $30 a share, but now it's worth $400 plus. If you sell, you're paying long-term capital gains on that massive gain. But let's say you bought Tesla 5 years ago at $200, it's split adjusted, and now it's $250. Your gain is much smaller. The real question is, which sale creates the smaller tax bill? Sometimes the answer is sell one with the larger gain because you have capital loss carry forwards, or sell the one with the smaller gain to minimize the taxes. You really need to run these numbers with your CPA or your financial advisor. Tax implications can completely change which stock that you should actually sell. Here's factor number 5, income generation. Here's a simple one. Does the stock pay a dividend? Microsoft pays a quarterly dividend. Currently, it's only around 0.75 annually. It's not huge, but it's something. That's passive income hitting your account 4 times a year. Tesla pays 0 dividend. You only make money if the stock price goes up and you sell. The retirement question, if you sell the dividend payer, you're giving up that income stream. If you sell that non-dividend payer, you keep the quarterly income. For retirees who need income, consider keeping the dividend payer, especially if it's also more stable. Now, here's factor number 6, volatility tolerance. Here's the psychological piece. Let's say that you sell Microsoft and you keep Tesla. 6 months later, Tesla drops by 40%, which it's done before. How are you going to feel? Will you panic? Will you sell at the bottom? Will you lose sleep? Or let's say that you sell Tesla and you keep Microsoft. Tesla then doubles over the next year. Will you have seller's remorse? Will it eat at you? The retirement question is this. Which outcome can you emotionally handle better? For most retirees, it's easier to live with missing gains than it is to stomach losses. That suggests keeping the more stable stock. Okay, let's create a scorecard here. I want you to think through these different factors whenever you face this particular situation. For each stock, ask yourself this. Number 1, stability. Which has more diversified, stable revenue today? Number 2, earnings. Which has more predictable profits right now? Number 3, competitiveness. Current. Which has a proven wide moat generating cash? Number 4, competitiveness for the future. Which has greater transformative potential? 5, taxes. Which creates a smaller tax bill if sold? And 6, income. Which pays dividends? 7, volatility. Which could you emotionally handle? And then 8, time horizon. How long until you need this money? In your Microsoft versus Tesla example, Here's how it breaks down. Microsoft wins on stability today, earnings predictability, a proven current moat, income generation, and lower volatility. Tesla wins on future transformative potential and possible explosive growth. The decision comes down to, do you need stability and income now, or can you wait for the potential transformation? Here's what this decision really comes down to for Microsoft. It represents the bird in the hand, reoccurring subscription revenue, predictable growth, dividend income, lower volatility. You know what you own. Tesla represents two birds in the bush, potential AI and robotics revolution, autonomous driving at scale, but it could be speculative and volatile. You're betting on a vision. Both are valuable. The question is, which is more valuable to you in your situation? Now, if you're 68 and you're retired and this money matters for your lifestyle, the bird in the hand usually wins. If you're 62, still working part-time, you have a pension, and could be patient, two birds in the bush might be worth the risk. The framework doesn't tell you what to choose. It tells you how to think about this particular choice. Here's a strategy that many retirees don't consider. Don't make it an all or nothing choice. If you need the 25,000, sell 12,500 of Microsoft and sell 12,500 of Tesla. This way, you could accomplish two things. You keep the exposure to Microsoft's stable subscription income, and you keep exposure to Tesla's AI and robotics potential. You reduce your concentration in both, and you don't have to pick a winner. Sometimes the best answer is both are valuable, keep both, just in smaller amounts. This is especially smart if both positions have grown to be oversized in your portfolio. You genuinely see value in both investment theses, and you want to hedge your bets. Remember, in retirement, diversification often beats conviction. Now, if you're facing this decision right now, here's what to do. Step one, list out the stocks that you're considering selling. Step number two, run through each SEC framework plus the additional retirement factors we've discussed. Number three, calculate the tax impact of each sale with your CPA, just in case you missed something. Step number four, consider your overall portfolio allocation, not just those two. Are you overweight in one sector or the other? And then step number five, make your decision based on a framework, not emotions or opinions. Step six, document why you made the decision. Write it down. Now, this helps you to avoid the second guessing later on down the road. And here's my biggest piece of advice. If this feels overwhelming, work with a fee-only fiduciary advisor, someone who can look at your complete financial picture and run the tax projections and can help you to make the decision that's right for your situation, not your neighbor's situation, not your golf buddy's situation, yours. You know, I like to bring in biblical wisdom when it's appropriate. And I like, in this situation, Proverbs 21:5. And it says this: the plans of the diligent lead surely to abundance, but everyone who is hasty comes only to poverty. Making investment decisions hastily based on fear or greed or what someone else thinks, that's a path to regret. But being diligent, using a framework, considering all the factors, seeking wise counsel, that's the path to confidence and peace. Maybe not profits, but peace. Whether you sell Microsoft, Tesla, or something else entirely, do it diligently, do it thoughtfully, be a good steward of what God has entrusted you to. Here's what I really want you to take away from today. In retirement, your investment strategy should shift from growth at all cost to stability with reasonable growth. When you're 35 and you're working and you can afford to take big swings, if the stock drops 50%, you've got 30 years to recover. When you're 68, you're retired and you don't have that luxury, preservation becomes just as important as growth. Now, that doesn't mean that you should only own bonds and CDs. You still need growth to combat inflation, but it does mean this: favor stability over volatility, favor predictability over unpredictability, favor income over pure appreciation, and favor proven moats over disruptive potential, unless you have the time and the risk tolerance for the disruption. Now, these principles guide every which stock should I sell question that you have in retirement. All right, let's recap. The SEC framework for retirees. Number one, stability. Keep the stable business model with diversified revenue. Number two, earnings. Keep the predictable profits. Number three, competitiveness. Current. Keep the proven moat, the wide moat. Number four, competitiveness for the future. Consider the transformative potential if you have the time. Five, taxes. Minimize the tax hit. Number six, income. Keep the dividend payer if you need income. Number seven, volatility. Sell what keeps you up at night. Eight, time horizon. Match the investment to when you need the money. Use this framework every time that you need to raise cash in retirement. And remember this: there's no perfect answer, but there is a thoughtful, informed answer. And that's what this framework helps you to find. If you found this information helpful, please subscribe and hit the bell icon for notifications. Drop a comment below. Have you ever had to make this kind of decision? What stock did you sell and why? I'd love to hear what your experiences are. I'm Van Richards, and thank you for joining me today on the Retirement Learning Lab.